Today we are creating a narrative or constructing a narrative regarding fixed assets. So firstly, what is the definition of a fixed asset? Well, fixed asset, another terminology for it is tangible assets, or a component rather of fixed assets or tangible assets. And whenever you think of tangible, it means it is something that can be touched. So tangible, T for touch. And we also know what an asset is, because obviously fixed asset is a subcategory of assets. An asset is the possessions of a business, or in other words, that which the business owns. We also need to ask ourselves what the purpose is of a fixed asset. Well, we know that fixed assets are used to generate income for a business. Examples of fixed assets will be land and buildings, equipment, vehicles. Those are the main asset classes, fixed asset classes that we deal with. Now, next we focus on acquiring fixed assets. We know as a business we are going to need fixed assets to generate income, and therefore we will have to possibly buy fixed assets. So now here it is important to realize that we always obtain fixed assets at historical costs. The reason is it is the only objective value that we can determine. So it will remain in our books at historical costs, all our fixed asset accounts, such as land and buildings, equipment, vehicles, etc. So what we need to realize, the cost price that is the purchase price, but we also have to add direct costs. An example of direct costs will be if you purchase a vehicle, you might want to install aircon if it's not already part and parcel of the vehicle. So that installation cost will add to the value of the vehicle, so it will form part of the cost price. Now let's look at structure. The double entry principle we know applies. So we know assets increase on the debit side. So therefore, if we acquire or purchase or obtain fixed assets, we will therefore have to debit the particular fixed assets, whether it is equipment or land and buildings or vehicles. So we will have to credit therefore another account, and that will now depend how we finance that fixed asset. So we could credit creditors control if we purchase or acquire the fixed asset on credit. Bank will be credited if it was a cash transaction. If we obtain land or buildings via a long-term loan, we call those loans mortgage loans. We will credit the mortgage loan. And then if the owner contributed the fixed asset, then it would be the capital account that will be credited. So next we are focusing on the lifespan. How long do we intend to use the asset? Okay, that is basically the definition of lifespan. How long economical useful will the particular asset be to the business. For example, vehicles, often the lifespan will be deemed to be as long as what the warranty applies. We also use this concept of the lifespan to determine our depreciation policy for the straight line method. Note it only applies to the straight line method or the cost price method, not the diminishing or reducing balance method. Okay, so for example, if our useful life, let's first determine the percentage. So to calculate the percentage using the concept of the lifespan, we simply take 100 and divide it by the lifespan. So for example, if we know that the warranty on our vehicle is 5 years and we deem that will be the useful life of our vehicle, then we will have to divide 100 by 5 and then we obtain 20%. So we will have to depreciate that vehicle every year for 20% so that it has a carrying value of 0 by the end of 5 years. So the lifespan, we can also write that in equation form. It is simply the cost price of the asset divided by the amount of depreciation. So if the cost price of our vehicle is 200,000 Rand, and we already calculated that we use 20% depreciation on the cost price method, then 20% of 200,000 is 40,000 Rand. So if we divide the 200,000 by the 40,000 Rands depreciation, then we will get 5 years again as our lifespan. Depreciation, let's just define that. It is an expense that reduces the value of an asset each financial year. We know we record the asset at historical cost, but it's logically sensible that over time the value of the asset should reduce. Now the thing is, we cannot show this reduction in the fixed asset account, as we need to consistently apply the historical cost principle. So in the fixed asset account it will always be at historical costs. So we have to create another account which we call accumulated depreciation, which is a negative asset account. So it goes hand in hand with the actual asset account, and it shows by how much the value of the actual asset reduces over time. So the accumulated depreciation is just the sum of all of the depreciations of all the previous years or financial years. Then the actual value to the business of the asset we call the so-called carrying value, which is the cost price minus this accumulated depreciation. So if we think in terms of structure, we know that accumulated depreciation is a negative asset, so it should have credit balances. So that is given that we know that assets have debit balance. So negative asset is the opposite of a usual asset. So therefore we know we have to credit accumulated depreciation. We will have to debit therefore depreciation, which is in our expense account. And note, it is an expense where there's no outflow of money. It's simply a book entry that we record in our general journal. So how much depreciation in the period that we acquire or purchase an asset depends on the timing. When did we purchase the asset during that financial year? So if it's on the first day of the financial period, we will have to write off a full year's worth of depreciation at the end of the financial year. If we acquired it somewhere during the year, we will only have to calculate depreciation for the portion of the financial year that we use the asset. So if it was in the middle of the year, we will only have to write off half a year's worth of depreciation. If it was like towards the end of the year, say the beginning of the last quarter, we will only have to write down 3 months of depreciation. And then the third scenario is if we actually acquired the fixed asset on the last day of the financial year. In that case, obviously there is no depreciation to record. So next we need to focus on the valuation of fixed assets. We know our default is to record at historical costs. Okay, but actually it's a bit more tricky. According to international financial accounting standards, assets need to be recorded at the lowest of costs or net realizable value, which we can abbreviate to NRV, based on the prudence principle. We know the prudence principle state that we are mostly, or we are actually conservative. So we would more easily show a loss, and we will be careful to show a profit. So the definition of the net realizable value is basically what can you actually obtain for your asset in the open market, where there's free supply, or where demand and supply freely determines prices, and then subtract from that value how much it will cost you to get rid of the asset, because sometimes if you sell an asset, you will also have to incur transport costs to get it to the buyer, the new buyer, or other costs might be incurred. So the costs that you incur to actually get rid of the asset, subtract that from the market price that you could obtain, and that will be indeed the net realizable value. When we replace an old asset, we deal with what we call the replacement rate. So the replacement rate is simply the cost price of the new asset, and we have to reduce it by what the old asset is worth to the business. In other words, the carrying value of the old asset. So that's so basically the replacement rate is simply what do we need over and above the value of our old asset to obtain the new asset. There are going to be times mostly after the useful life of an asset, that we are going to need to dispose or get rid of our fixed assets. Now, related to this is the concept of the age of a fixed asset. We know that the cumulated depreciation is simply the sum of all the depreciations over the lifespan of the asset. So if we divide that total depreciation, namely the accumulated depreciation, by the depreciation for a year, we will get the age of a fixed asset. Take note that this though only works for the straight line method of depreciation, or the cost method of depreciation. It does not work for the diminishing or reduced balance method of depreciation. So as an example, let's say we have an accumulated depreciation of 80,000 and our depreciation per year is 40,000. So if we divide the accumulated depreciation by the depreciation, we know that the asset at this point of time is 2 years old. Now, when we deal with asset disposal, we create an account that we call the asset disposal account. The purpose of that account is to record all the transactions that relates to asset disposal in order to determine whether we made a profit or a loss in the whole process. So if we look at the procedure or this and the structure, then the first thing that we need to do is to remove the fixed asset at cost. Because we know in our asset account we have a debit balance for assets, and now if we are going to get rid of that asset physically, we also have to get rid of it out of our books. So since assets have a debit balance, we will have to credit the fixed asset at cost. Therefore we will have to debit this newly created account, namely asset disposal. So debit asset disposal, credit the fixed asset account, whether it's vehicles or equipment or land and buildings. Furthermore, we know we also have for every asset, fixed asset, we have a negative asset account, accumulated depreciation. So we also have to remove that. But before we can do that, if we get rid of an asset during the course of the year, we will first have to calculate the depreciation on that asset up till the time that it is disposed of. And we know that will even further increase the accumulated depreciation, our negative asset. So we will have to credit our negative asset, accumulated depreciation, and debit therefore depreciation, our expense account. Okay, so and that is only during the year. Obviously, if it was the first of the financial year, there would be no effect. There is no depreciation to write down. Okay, but during the financial year, we will have to calculate the partial year's depreciation, and the last day of the year, it will be a whole year's worth of depreciation that we have to write down or write off. Okay, so as we said, we debit depreciation, the expense, and we credit the accumulated depreciation on the fixed asset. And therefore, now we are ready to actually remove the accumulated depreciation on the fixed asset. Since accumulated depreciation is a negative asset, it has a credit balance, so we will have to debit to get rid of that accumulated depreciation. So therefore debit the accumulated depreciation on the fixed asset and credit our asset disposal account. Okay, so then the next step is we have to consider or record the consideration that we receive, and that will now depend on how we got rewarded for getting rid of the fixed asset. So if we got rid of it for cash, we will receive the money, our bank will increase. Bank is an asset, so we will debit bank. If we sold it on credit, our debtors will owe us money, so debtors control would be debit instead of bank, which also makes sense because debtors is an asset. If people owe us more, we will have to debit their account, so we debit debtors control. Or if it is a trade-in, it will be creditors control, because we will now have gotten a more expensive asset, and part of that cost of the more expensive asset is set off for what we get for our asset that we get rid of. So we owe our creditors now less by the value of what our old asset was worth. And we know if we owe less, we are talking about liabilities that reduce, and liabilities reduce on the debit side, so we have to debit creditors control at the selling price, and therefore we will have to credit our asset disposal account. And then finally we will have to determine the profit or loss on asset disposal, and that will be the balancing amount. Okay, and it may be a debit or a credit depending on whether we made a profit or a loss. If we made a profit, it means we will have to credit another account, namely profit on asset disposal. So for each credit we have a debit, so it means we have to debit the asset disposal account. The opposite relates to if we made a loss. If we made a loss, we will have to debit our expense account, loss on asset disposal. We will therefore have to credit the asset disposal account. And if we got rid of an asset at carrying value, there won't be an entry in this regard, because we know that the profit or the loss is the consideration of that the selling price minus the carrying value. And if the consideration is the carrying value, you have carrying value minus carrying value, which just give you 0. So there's no entry for when we get rid at carrying value in terms of the consideration leg. The fixed asset register is an important document where for each and every single asset we record all the vital details in relation to that asset item. Like for example, the date of acquiring the asset, the supplier from whom we required the asset, any warranty or guarantee details, this full description of the asset, such as the make and the model, the year, then also the depreciation method used to reduce the value of the asset, the rate of reducing the asset, the carrying value of the asset, the date of disposing the asset, the consideration received for disposing of the asset. All of those details we'll find in the asset register. So in a sense, the asset register is an important internal control measure, as we can compare what's in the fixed asset register to what is in the general ledger accounts for the fixed assets, as well as using it to construct the fixed asset or tangible note for our financial statements. So if we look at the structure of the fixed asset note, then it's important to realize that we have the different asset classes at the top, and then we have a total, so we have to total them up. And we start with the carrying value at the beginning of the year, what our asset class is worth at the beginning of the year. Then we have the movements during the year, which will result in the carrying value, or what the asset is worth at the end of the year. The carrying value at the beginning of the year, we know, is simply the cost minus the accumulated depreciation. So here we have an equation, and cost will always be positive values. And we can't have a negative value for costs. Asset is always worth something, and we have to subtract the accumulated depreciation. Therefore, that it's in brackets. It makes sense, because accumulated depreciation by definition reduces the value of an asset. When we look at movements, our additions, we are adding to assets, so we're adding value, so it has to be positive. When we dispose, we are getting rid of assets, so therefore it will have to be in brackets. It reduces the value. Depreciation also by definition reduce the value of assets, so therefore it needs to be in brackets. Now depreciation, let's just focus how to determine the amount for depreciation. So there are 3 calculations that we have to make in order to get the proper depreciation amount. We have to do 3 separate ones and add them together, worst case scenario. In easier scenarios it might only be 1 or 2, but worst case it's 3. So we first have to calculate the depreciation on those fixed assets that we use right throughout the financial year. In other words, we did not buy them during the year, we didn't dispose them during the year. It was a fixed asset that we had at the beginning of the year. We also have that very same fixed asset at the end of the year. So that's one group that we have to consider. And what's very important here is to actually reduce the cost price, or the opening balance at cost, by any asset that we got rid during the financial year, because that we are going to treat separately. It might also be that we have to reduce the accumulated depreciation if we are using the reducing balance or the diminished balance method, as that method is using a rate on the carrying value, which is nothing other than cost minus accumulated depreciation. So if we got rid of an asset during the year on which we use the diminishing balance method, we will also obviously have to get rid of the accumulated depreciation of that particular asset. So then we also have to calculate the depreciation on the fixed assets that we in fact disposed during the year, for that small portion of the year that we actually had it. Well, it could also be a large portion if we got rid of it fairly close to the end of the financial year. But fact of the matter is, we need to calculate the depreciation for the portion of year that we use that asset. And then finally, any new asset that was acquired during the financial year, we have to calculate the proportional amount of depreciation on there. So if we, for example, purchase maybe in the middle of the year, we will have to calculate the depreciation from the middle of the year to the end of the year, in other words for half an year. And then we can add these 3 amounts. Obviously some of them might be 0 if it is not applicable, but this is the general case that will always work. Now with that out of the way, let's just go back to the structure of our fixed asset note to focus on the intrinsic relationships. So the carrying value at the beginning of the year, we know is the cost minus accumulated depreciation. So that is in fact our first crucial that's our first crucial equation that we already have referred to. The carrying value equals the cost minus the accumulated depreciation. The next one we have to focus is cost. So if we take the cost at the beginning of the year, we add the additions which is at cost during the year, and we subtract disposals, not at carrying value but at cost during the year. We will get the costs at the end of the financial year. So in equation form, it would be the carrying value at the beginning of the year plus additions. Okay, the carrying value at the beginning of the year plus additions at cost minus disposals at cost will give the costs at the end of the year. Then the next relationship that we can focus on is the accumulated depreciation. So if we take the accumulated depreciation at the beginning of the year and we add we take the accumulated depreciation at the year, yes, and we add the depreciation because it will just make the accumulated depreciation more. By definition, accumulated depreciation is the sum of depreciations over the years. So let's restate: accumulated depreciation at the beginning of the year plus depreciation during the year minus the accumulated depreciation related to the assets that we disposed during the year equals the accumulated depreciation at the end of the year. In equation form, we can show it as accumulated depreciation at the beginning of the year, which we increase by the depreciation during the year, but then if we get rid of assets, we have to subtract the accumulated depreciation on the asset that we dispose to get the accumulated depreciation at the end of the financial year. And then finally, we have the carrying value. So the carrying value at the beginning of the year, we can add the additions at carrying value, which is the same as cost because we haven't written off any depreciation on any new item during the year. Okay, so we have the carrying value at the beginning of the year plus additions. We have to reduce the value by disposals at carrying value, so subtract that. We have to reduce the value of our assets by depreciation, so subtract that, and then we will have to get the carrying value at the end of the financial year. So carrying value at the beginning of the year plus additions at carrying value, which is equal to costs, minus disposals of carrying value minus the depreciation gives us the carrying value at the end of the year. So all of these are just equations. So if only in a given equation, if only one of the values is unknown, we can simply rearrange the equation so that that value is on the left and the others on the right, and then calculate the unknown value. So it is simple mathematics. One last thing that I need to point out in terms of the fixed asset note is that the carrying value for a particular asset, if it is still in use, it has to be at least R1. We won't record it as 0. 0 means basically we dispose of it, we got rid of it. So if we have written down all the depreciation on an asset, we will need to keep it as a value as R1 if it is still in use in the business. So this is a narrative of fixed assets, and you can see it's maybe about half an hour for each story. And I mean, maybe let's say you have maximum 12 stories over the year, so it's maximum of 6 hours. If you can tell that story in detail, then I'm sure you will start to master accounting. The more you tell a story, the more it becomes part of you, and each time you tell a story, or each time that you listen to the same story, there's something new that you actually tend to pick up that you did not realize before.